Hi everyone, John Boardman, founder and CEO of Ballast, and I want to touch on a commentary we published yesterday on the Silicon Valley Bank issue and more or less crisis that bank went through last week. We've had a number of questions from clients about the situation, and then also any advice that we have as it relates to their deposit accounts. For more details on the specific crisis, I would ask you to go to the commentary, as we have written a few pages on the issue. But simply, it was a unique crisis. Silicon Valley Bank is unique in a number of ways. Most of its depositors are in the tech industry, venture capital industry in Silicon Valley, and in 2021 and the beginnings of 2022 had a huge influx of deposits, which is a great thing for a bank, except that they invested those deposits in some longer-term maturity fixed income vehicles that unfortunately reduced in value when the Federal Reserve has increased rates over the last several months. The net effect of that was they owned investments as a bank that had depreciated in value, and they had a lot of requests for deposits to be withdrawn over the last several weeks, and particularly the end of last week when over $40 billion was removed. It was really a perfect storm crisis for a very niche-oriented bank. It definitely has sent shockwaves through the banking industry because the Fed, the FDIC, and the Treasury stepped up this weekend with really unprecedented measures, telling depositors who had deposits over the $250,000 limit that they would be protected on those deposits. That type of plan is typically reserved for your very largest banks. They did deem SVB critical, and so it allowed them to come in with that measure, but you would typically expect that to only be reserved for the top several banks. We are uncertain at this point if this sets the precedent for the FDIC to come out and increase the limits on their protection or just to guarantee all deposits. Most of the statements that have come from the FDIC have said that depositors should feel safe. There's a lot of faith based in that statement, but at this point the rules still are that $250,000 is the limit on a bank deposit. This is not something that typically affects a lot of individuals, but it affects a lot of businesses. So those limits apply to both consumers and businesses, and the problem is you have companies that employ dozens, hundreds, or thousands of people that obviously maintains more than $250,000 in an account to make that payroll. So I suspect we will see some developments from the FDIC and the Fed and the Treasury over the coming weeks related to this, but as of this morning, it feels like the fear has sort of been eradicated somewhat from the market. And depositors are not running from smaller banks, which I think was one of the major concerns that you had coming out of the FDIC. But what can you do as an individual? I think the most important thing is don't panic. This is not something you cannot figure out, and we can obviously help you figure that situation out. I do advocate people limiting their exposure to a bank to the $250,000 limit. It's not difficult to do that, and there are a number of ways to do that through one institution. Just as an example, we can do that. We can actually go out and buy CDs for clients across multiple banks within one account. You also have banks that will allow you to own exposure to multiple banks through one account, usually called the Cedar system. If you can own, it allows you to own CDs where you're getting the FDIC coverage from multiple banks. U.S. Treasuries are also an option. There's sweep accounts. There's any number of things that you can do, but it is a fixable issue. It's just something, if you have high cash deposits, it's something you should probably consider. So feel free to reach out to us to talk about it. I think, again, don't panic. It's something that can be dealt with. We don't advocate people leaving smaller banks or regional banks. We have no major concerns. It's just something you can deal with. But it was an interesting story to say the least, and I would just invite you to read our commentary on our website at ballastplan.com. That's where we will house this commentary as well as this video and all of our previous commentaries. Thank you.